Welcome back to How to Value Business for Sale in 2022, Part 2. Today in Part 2, I'm going to be looking at the income approach being one of our three approaches to valuation and how we use it to calculate the value of a business. As the name suggests, the income approach looks at the income available to a business or any asset for that matter, but in this case we're looking at a privately held business and using that income to derive the value of that business. Now, the very basic premise here is that the value of a business is driven by all of the expected future income that it produces. So what exactly do I mean by income? Well, there are a range of different measures or metrics of income that we could look at or could consider to come up with the value of a business. This could be net income, which is where we look at revenue and we subtract costs and expenses to then come up with net income after those costs and expenses. Another more common metric to look at or you may hear about is called cash flow, which is very similar to net income. However, that often also is accounting for other expenditures to run a business, such as what we call capital expenditures, replacing machinery, expansionary plans, things like that. So today I'm going to talk mostly about cash flow, but effectively cash flow is just some measure of cash available to the business and its shareholders, if you will, after all the necessary costs and expenses to operate or run that business. So the value of all these expected future cash flows will give us the value of a business at a specific valuation date. Let's, for example, use today. So if I expect a business to be cash flow positive, as we call it, i.e. generate cash flow into the future, what I want to do is identify the value of all those cash flows, sum it up effectively, and then that will give me the value of that business. The only caveat here is that these are expected future cash flows, which means two things. One, there is a level of risk associated with these expected future cash flows. They haven't actually happened yet. So all we can do is we can look at historic actual cash flows and we can make projections or forecasts about what will happen in the future. But obviously there is a level of a risk attached to those expectations about future cash flows. Another key principle here is that a dollar today is typically worth more than a dollar received in 1 year or in 2 years' time. The premise here very simply being that if I say to you, would you prefer a dollar today or a dollar in a year's time? You would probably say today. As you know, you can take that dollar, invest it somewhere, and most probably it will be worth more in a year's time. So a dollar today is more valuable than in future. Conversely, future cash flows from a business that have risk attached to them are worth less today when we consider their value today. So we capture this through a process of what we call discounting, where we discount those expected future cash flows and we find out their value today. Once we have the value of all those discounted cash flows today, we sum them up, and as a collective, that gives us the value of our business. So when we're using the income approach, if you remember from the first video, within any of our three approaches, there are a range of different what we call valuation methodologies that we can use to value a business. Think of methodologies as just different techniques to valuation. Now, there's two primary techniques or methodologies, if you will, under the income approach. Now, I do warn here that depending on the valuation standards you're following, or depending on which country or where you are in the world, some of these names differ slightly. However, the fundamentals of these two methodologies are basically the same. The first methodology, which is more basic in nature, is the capitalization of income or capitalization of economic benefits method. So under the capitalization of income methodology, we make an assumption that effectively the cash flows of the business will basically be the same or flat into the future. We then discount each of these expected cash flows that we expect to be the same into future. We discount them at an appropriate discount rate back to their value today. So what is a discount rate and what is an appropriate discount rate? So the discount rate, as mentioned, is a reflection of the risk attached to the business and the cash flows that it generates. If you've got a higher risk business, then the discount rate will be higher, and then the value of those expected future cash flows will be worth less today than lower risk cash flows. So under the capitalisation of income method, we will come up with an expectation of future cash flows which are expected to be flat, and then we discount them back to today. So exactly when do we use this methodology, or when is it appropriate to use the capitalisation of earnings methodology? It's most applicable or appropriate for businesses that are not expected to grow by much in future, rather have sales and cash flow that is somewhat flat. This is in contrast to the second methodology most commonly used under the income approach, known as the discounted cash flow or discounted future economic benefit methodology. Sometimes the discounted cash flow, you'll also see the acronym being DCF. Now this is used or most applicable for businesses that are not going to have flat revenues or growth in future, rather we expect them to be growing at different rates depending on the year in future. So in particular, this is applicable for our higher growth businesses or businesses that are expanding at some point in future, where we model or we forecast the different cash flows each year. Think of it as you've got a general store and they're expecting to expand and buy or acquire more stores in future. This is when we would use the DCF as opposed to the capitalisation of income method, which may be applicable for a single store with no expansionary plans. Similar to the capitalisation of income methodology under the DCF, we then discount these cash flows back to present value or the valuation date at an applicable discount rate to reflect the expected riskiness of those cash flows. Obviously, it's up to the individual appraiser or valuer to identify which of these two methods is the most applicable in determining the value of a business in 2022. In the next video, I will look at the second approach to valuation, being the market approach. Look forward to that with you soon.